Welcome back to our monthly series with Greg McGeorge from JMI Wealth. In this episode, Greg speaks to us about behavioural economics and why do we make dumb decisions when it comes to our long-term financial well-being. Greg loves talking to clients about this and helping them understand the psychology behind the decisions that they make with their investments. So please do feel free to reach out to Greg to discuss this. Now, Greg from JMI Wealth hold over $6 billion worth of investments between themselves and their wider group, and so we will link to their details as well. I hope you enjoy it, and if you do, please do like and subscribe. So, behavioural economics, right? I love the headline. It sounds, why do we make the dumb decisions that we do? Sounds more psychology than economics, though.
Yeah, you're right. It is a great headline. But at the same time, unfortunately, it's actually very true for many of us. And you're right, behavioural economics is part psychology, but also part economics. And as you said, it tries to explain why we make dumb decisions when it comes to our long-term financial well-being. Whereas traditional economics assumes that individuals are rational and we always make decisions that are in our best interest. Behavioural economics, though, challenges this notion by exploring how our biases, emotions, and social factors influence our decision-making process. So when it comes to financial decisions, we can often be tricked, or we even trick ourselves into believing that we are making the right choices with our money, because we often base those decisions on things like rosy projections, past performance, linked events, or even worse, we base things on things like emotion, sentiment. We let them get in the way. And it's these biases. These type of biases seldom lead to smart financial decisions when it comes to our investments. And the reason I want to talk about this is these insights from behavioural economics are particularly important for financial advisors like myself. We often become the voices of reason for our clients, educating them on why they should consider certain strategies, or more importantly, why they shouldn't consider certain strategies. So the first step is managing expectations and helping clients understand how they handle different situations. Because people often think they are risk averse until they suddenly need to take on risk to achieve their goal. And sometimes the risk they need to take on can actually be quite extreme. So it's about coaching clients into taking some risks early on so they don't need to take on a lot of risk later in life.
And so how do you get a client to think about it?
Or
think like that?
No, you're right. It is a mindset. So, there's an exercise I like to use. So when a client says they are risk averse and say only want to be in cash and bonds, so I walk them through a simple scenario. So two scenarios. So each scenario has two options, option A and B. And you need to choose just one option from each of the scenarios. So option one is if I give you a choice of, say, option A, 100% guaranteed that you will get $100,000. Or option B, an 80% chance that you will get $1 million, but with a 20% chance that you will get nothing. What would your reaction to that be? A, 100% guaranteed?
Yeah.
No, and that's
at my stage of life, I might roll the dice on the million.
Yeah. The interesting thing is, though, most people will take that guaranteed, 100% guaranteed option. Yeah. So they've got that gain, they don't want to risk it. And, guaranteed option sounds like a no-brainer. After all, why gamble even though there is an 80% chance of getting 1 million when there is a 20% chance of losing money? That just sounds painful. So scenario two, it's basically the same question, but let's now turn it about and talk about dealing with losses. So scenario 1 was all about dealing with gains. So just like scenario 1, scenario 2, we have 2 options. Option 1, you have a 100% chance of losing $800,000. Or option 2, you have an 80% chance of losing $1 million. But there's a 20% chance of losing nothing.
Yeah.
So which sort of option would you be looking at there?
Definitely the second one.
Yeah, correct. And this is the fascinating thing. So now you're happy to gamble. That first option, that first scenario, no, I like that guaranteed win.
Yeah.
Suddenly the second scenario, same question, but now your mindset, you actually want to gamble. So as I said, first scenario, guaranteed 100K, great, you want to take that. Yet in scenario 2, you had a guaranteed loss of 800,000, but now you're willing to gamble that and take on the risk, knowing there's an 80% chance that you're going to lose $1 million. So it's exactly the same question in terms of probability as well. So if you from a probability point of view, it's exactly the same outcome. The difference is behavioural economics. When people are faced with an $800,000 gain, they tend to be risk averse and won't gamble to get the 1 million, even though there's an 80% chance. But when it comes to an $80,000 loss, they are more than happy to gamble, and suddenly they become risk seeking in the hope of hitting that 20%. Yeah. Right. So behavioral economics calls this prospect theory. It tries to explain that we are far more emotional when it comes to losses than we are when it comes to gains.
Right.
Yeah. So actually, a great example is myself personally. Casino. I went to the Christchurch casino a few weeks ago. I won $100 playing blackjack. Yeah, very happy. I felt good. It was nice to win. Then a few weeks later, I was in Melbourne for a weekend and went to the casino there. I lost $100 playing blackjack. Now, traditional economics would tell me making $100, losing $100, gain, loss, net, it cancels each other out, right? It's just the same thing. But you'd be wrong, because behavioural economics tells me, actually, a $100 loss was much more painful to me than the joy I experienced winning $100. Yeah. I mean, it's totally irrational. It's the same thing. It cancelled each other. But my emotional feelings was so much greater suffering that loss. So there we go. And you could use my casino experience in the same way we discussed in those first 2 scenarios. So when I was up $100, would I have been willing to take on extra risk and say do double or nothing? No, because I had the money there. Why would I want to double it with the risk of getting nothing? So no, I was a conservative gambler. I don't know if there is such a thing, but but when I was losing, am I now more likely to consider a double or nothing strategy to get my money back? Probably. And that type of thinking is wrong, right? So these type of scenarios help clients understand the difference between being risk averse and loss averse. As we saw in those 2 scenarios, while risk aversion makes people avoid taking risk for gains, loss aversion can lead that same risk averse person to take on huge risks to avoid losses, even if the potential loss could be far greater. And so people are used to thinking short term, right? So they don't want to take on risk. The reality is, and this is really important, most investors don't want to take a risk to get rich, but they will take an outsized risk not to get poor.
Wow.
Yeah, it's fascinating. If you've got the money there, why risk it? However, if you don't think you've got the money there, then you are going to, unfortunately, take on risk, even though you don't want to. It's against your nature. Yeah. So if our clients can understand that concept, now they can see into the future, I guess, and they don't they don't want to be in that situation whereby they are forced to take on huge gambles in order to keep their wealth where they want it. And the biggest risk to anyone's long-term wealth is inflation. So by being risk averse, you open yourself up to not having enough money later in retirement. So now risk averse clients understand that running out of money in retirement is far more frightening than a few ups and downs in the financial markets in the short term. So they get over that fear of the short-term risk averse, knowing that if they don't do the right thing now, they could be faced with that loss aversion scenario where they have to gamble. So that's a really interesting conversation to have with clients, and most of the time they get it. They go, oh yeah, okay, yeah, I really do not want to be poor in retirement. So
is that, sorry, supplementary question here, is this an easier conversation to have now with these clients? Because we've just lived through 2-3 years of rampant inflation, so they get it. Whereas if you were trying to have this conversation 4 years ago and say you're going to lose your money to inflation, would they have appreciated that?
Yeah, that's a good point actually, because people are very short term. So inflation 0-1%, yeah, but it's not always going to be 0-1%. You know, historically, if you look back, and this is part of the coaching, it's like, yeah, great, it's 1-2% now, but I can guarantee you that will not be the case in the future because everything is cyclical and it will come back. So it is very much a coaching thing as well, and also about the volatility in the markets. It's an interesting conversation because now we have seen big drops in the markets and they've just come straight back. So actually I've been finding it's an easier conversation. It's like, oh yeah, I saw that big crash and it just came straight back, didn't it, Greg? I was like, yeah. Great.
Yeah. Oh, I can live with that. Yeah.
So it's fascinating. So those risk-averse clients who want to be invested 100% in term deposits or bonds, while less risky over the short term, it's actually very risky for their long-term retirement and happiness as they run that risk of not having enough money to live on later in their retirement. And it's this fear of running out of money that can be far more motivating to them just the fear of investment risk. So I highlight the potential long-term impact of inflation and the erosion of purchasing power to help the clients understand that being overly conservative early on with their investments can lead to a very different kind of risk, and that's the financial insecurity in later years. So the key is to help them see that taking some risk in investments early on, and it doesn't have to be huge risk, but that you need to have some allocation to those growth assets. So taking risk in their investment strategy can be very proactive measure to ensure they have those sufficient assets rather than, and many people just avoid risk for the sake of avoiding risk.
So Greg, as we talk about all of this stuff, right, have we known about this stuff for years, or is the study of behavioural economics relatively new?
Yeah, it's interesting. The roots of behavioural economics can be traced back to the early 20th century when the likes of psychologists like Freud suggested people don't act rationally, but it didn't gain significant momentum and recognition until the 1960s when two psychologists by the name of Daniel Kahneman and Amos Tversky started conducting research into cognitive biases, such as prospect theory, as we discussed in those two scenarios, which showed how people value gains and losses quite differently, leading to irrational decision making. But one of my favourites in terms of their research was on something called availability bias, which shows that people tend to overestimate the frequency and likelihood of events, and typically dramatic headline-catching ones that are obviously easy to recall from memory, such as plane crashes, shark attacks, or of course stock market crashes. This bias can lead to irrational risk assessments. Take the S&P 500, which tracks the 500 of the biggest companies in the US. The S&P 500 has finished the year higher than it started about 73% of the time. This statistic, is based on data going back to 1957 when the S&P was first introduced. So it has ended the year higher with a positive return roughly 3 out of every 4 years. However, because news headlines tend to focus on negative effects, we often hear only about those dramatic, gut-wrenching sell-offs that wipe billions of dollars off the market, and we don't hear about the amazing long-term growth the market year in, year out returns to investors. Just look at the start of August. It's a classic example. We experienced an extraordinary sell-off in the markets with a huge spike in volatility. The media loved it and reported extensively on the potential for a new financial disaster. But what happened next? What happened for the rest of the month? Markets bounced back. They either reached new highs or came close to hitting new highs. Yet there was little or no mention. In fact, there was no mention of this recovery in the media. So due to this availability bias, some people may only recall the negative news but they make these irrational decisions. As far as a lot of people are probably concerned, that August was probably one of the worst months in the markets ever. Well, actually, the global stock market, the Nikkei, was up 1.9% in August.
Yeah. Look, I've seen this time and time again with people saying if it's hit the news, it's probably not true anymore.
Yeah. Correct.
Now, when I'd asked about the behavioural economics being new, you said it's interesting. So, right, what do you mean by that?
Well, it sort of goes back to your point. How has this been around forever? How long have we known about it? So, it's a great point. And I find it interesting that we talk about behavioural economics as being discovered by these two psychologists in the 1960s. Because if you look at any advertiser's sale pitch through history, you'll find elements of where they have tried to exploit our biases to influence consumer behaviour. Early lottery systems in the 15th century became very popular in Europe. So these systems exploited several cognitive biases that we now recognise and name. The lottery would go back to the availability bias we just discussed. So that's preying on people overestimating the probability of unlikely events that are easy to imagine, right? Adam Smith's famous book, Wealth of Nations, in 1776, he also discussed concepts related to behavioural economics. For example, he noted how people tended to overestimate their chances of success, which we now call optimism or overconfidence bias. So these examples show that even centuries ago, savvy business people were tapping into human psychology to influence behaviour, long before the term behavioural economics was actually coined. So I find it fascinating to see how these strategies have been used throughout history, even if they didn't have the terminology to explain it.
Yeah. So I agree, and that's fascinating. But so what is it that makes us think this way?
Yeah, and countless number of reasons that shape the way we think and the biases we pick up. These can be educational, the media, of course, our peer group, culturally, politically, and even historically. For example, those who grew up during the Great Depression were a generation that was extraordinarily frugal, adverse to risk, especially obviously when it came to the stock market. The trauma they experienced altered a whole generation. Their beliefs and outlook on the world and their economic choices, just not in the financial markets, but in many other parts of their daily decision making. So major historical events and experiences you lived through during those formative years can leave a massive imprint on your future decision making. A good example, I've had numerous conversations with people who experienced the 1987 stock market crash, either personally or through parents. And they've sworn to never touch the stock market again. This is another example of availability bias, where people overestimate the probability of events occurring that are easy to recall or are emotionally impactful. Explaining that while the 87 crash was significant and no doubt very emotional for them, it's just one of many market events. That's what the markets do. And this is the whole point of behavioural economics. It's trying to explain why we have irrational feelings and we make irrational decisions based on our emotions instead of the facts. I use visual aids showing how the markets have always recovered, to help contextualize their fears. But for a lot of these people, it's more an emotional thing for them, and that's when I have to turn to behavioural economics. That's when I have to almost fight fire with fire and use emotions to change their views. Sometimes just having facts and figures isn't enough. And this goes back to the discussion I have with clients about potentially running out of funds in retirement if they don't do the right thing now. So if they stay in cash because they're so risk averse, they may be in that position that they become loss averse and they do not want to be there. So I try to create an emotional nudge. So rather than putting statistics and graphs in front of them, showing them that indeed, markets crash, but look, they just go up, they crash, and they go up. So, instead I try to create that emotional nudge, and that's often the prompt to help them act.
Yeah. So Greg, as we know, you've worked in financial markets for your whole life and you've seen some catastrophes over that time. I understand you landed in London just before the 87 crash. You were there on the market floor when the UK pound left the
ERM, yep.
The ERM. Structuring mortgages in 2007 when the GFC hit. So tell me, I'll assume it's not all your fault, but can you tell me, what are the cardinal sins that you see when markets go wrong?
Yeah, and that's a good point. So you mentioned all those extraordinary moments in financial history. You also had the tech wreck. I had clients trading NASDAQ the wrong way when that happened.
So the 2000 tech wreck. Yeah, okay, yeah, another thing on your CV.
Lehman Brothers is on my CV as well. So the volatility and panic that ensued in all of those financial crises. We saw massive declines in the market, but where are the markets today? Higher and higher and higher. But getting back to your question, for me, definitely leverage, right? An underlying thing, leverage. But also something called the disposition effect. So the disposition effect refers to the tendency of investors and traders to sell winning investments too early while holding on to losing investments for too long, and generally also over trading. These are often governed by emotional bias. But I've got some really bad news now, Rick. It gets worse, right? Especially for you and me, because research has shown that women are less prone to it than men.
Right.
Yep. So, Jackie's going to be watching this, right? And she's going to go, right, I want your Hatch and shares log. You are not touching those accounts anymore.
Yeah. Look, I know what it's like. I was in my sharesies in August, as you say, it crashed. And I was like, oh no, what have I done? I am rubbish at this. What should I do? Sell the good stuff. But,
do nothing.
Yeah.
Correct.
And then within a fortnight, I'm like, oh, it's back.
Wow.
Yeah.
Correct.
Cool.
So several studies collectively have shown that women investors and traders are less prone to the disposition effect, primarily due to lower levels of overconfidence, more conservative trading behaviour, and a greater tendency to manage risks effectively. So, it sounds simple, doesn't it? By avoiding common mistakes of selling winners too soon and holding on to losers for too long, you're naturally going to get a far, far better long-term investment outcome.
Yeah. So what would be an example, right, where investors have avoided this disposition effect?
Yeah, I quite like an example where investors actually weren't able to trade their investments. So the trade worked out brilliantly for them. They were essentially locked out. So in 2016, there was a hack on the Bitfinex cryptocurrency exchange where something like 120,000 bitcoins were stolen. Now, at the time, Bitcoin was trading at only 600 US bucks. So the hackers transferred the stolen Bitcoin to various digital wallets, and it remained hidden for several years. Then in 2022, right, the US authorities managed to recover almost all of the Bitcoins. But by 2022, of course, as we all know, Bitcoin had skyrocketed to over 40,000 US dollars, meaning the recovered funds were worth significantly more at the time of the theft. So this twist meant that although the victims couldn't access their funds for years, they ultimately benefited financially due to Bitcoin's appreciation. They knew what was happening with the price of Bitcoin, but they just couldn't do anything about it. So just imagine the scenario. If the coins were never stolen and the clients continue to have free access to them, I wonder how many would have fallen victim to disposition effect. Obviously not the women, but certainly the guys. The guys would have sold way too early. They would have seen it go from $600 to 1,000 and go, oh, this is amazing. And then sat back in horror as they watched it go to 40, 50, nearly 60,000
So they were
US.
locked out and got essentially a 60 to 80 times return.
Correct. Yeah.
Because they couldn't do anything about it. And yet none of them would have held on.
Correct. So, this example underscores that, the profound impact that behavioural economics has on real world investing. Understanding and managing our biases can be just as crucial as market knowledge. And that's behavioural economics. It teaches us that sometimes the best action is inaction, allowing our rational long-term interests to prevail over those immediate emotional impulses. And that's why I work with my clients, helping them to navigate those biases and to stay focused and just as importantly, understand the biases. It keeps them focused on their long-term goals and ensures that their investment strategies are not only informed by market dynamics, but also by an understanding of their own human behavior. And I find this approach leads to far more successful outcomes. Look, I won't say it's stress-free for the clients, but now at least the clients are better equipped to see that long-term big picture. They're more able to deal with the ups and downs of the market.
So this sounds like where you'd mentioned to me on the phone the other day, you drew a parallel to golf, didn't you? So it was the putting. They measured, measured the kind of
neural markers.
Markers. Were they good golfers or were they just average golfers?
They were better than us, Rick.
Right. Okay. So measuring these neural markers with guys putting. And the lesser the brain activity, the better the putting.
Correct.
So, overthink it, stuff it up.
Correct. The more you thought about the activity, basically the more you concentrated, the more unsuccessful you became, the more you tended to hesitate. So put it simply, don't overthink it and trust the process. Emotional overthinking hurts performance, in exactly the same way as markers. Actually, there was another. I think I mentioned this one. There's another good golf one. Did you know that professional golfers are less accurate trying to make birdies and eagles when they're trying to make bogeys, right? So this is a perfect example of prospect theories. Golfers, just like investors, seem to hate losses more than they hate gains.
Yeah. Wow. One final thing before you disappear. Sidekick in Christchurch will be hosting an event on the 26th of September that we'd love to invite you along to. Now, the event is based on succession planning for business owners. Now, a key fundamental to succession is what are you going to do afterwards? So we've actually got Greg speaking to our audience about what to do with the money once you've sold a business. So if that interests you and you'd like to come along, please do reach out to us. The best email address for that is hello@sidekickca.co.nz. Many thanks.